Today, we're diving into a global financial shift that is causing shockwaves across the world. It appears that nations are uniting against a common foe: short selling. Countries like South Korea, India, and potentially the UK are stepping up to the plate, enforcing bans on not only naked short selling, but also tightening regulations on institutional investors engaging in day trading. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads, and also enter our giveaway. But everyone, remember, this is not a financial advice video. Let's begin with the latest developments from India. CNBC reported that the Securities and Exchange Board of India's SEBI has recently imposed a ban on naked short selling. This means institutional investors are now prohibited from engaging in day trading and executing ladder attacks. Furthermore, SEBI has heightened disclosure rules to ensure greater transparency in the market. Yash, our correspondent, delves into the details. According to experts, this move doesn't represent a significant departure from the existing framework. The key aspect is that naked short selling is explicitly prohibited in the Indian securities market. Additionally, all investors are mandated to fulfill their obligations of delivering the security during settlement. Institutional investors are not allowed to engage in day trading or square off their positions on the same day. To enforce these regulations, SEBI has empowered stock exchanges to take appropriate actions against brokers failing to deliver securities. So, India joins the growing list of countries that have clamped down on naked short selling. The implications are clear: institutional investors must locate and deliver shares during settlement, or risk being removed from the market by the stock exchange itself. This global trend is reshaping financial landscapes and bringing significant changes to how markets operate. Suzanne Trimbath, a financial expert, tweeted about the Korean stock exchange's decisive action against short selling. Not only did they ban naked shorting, but they also outright prohibited short selling. She likened it to watching rats abandon a sinking ship, indicating that the market corrected itself as the ballast short sellers was removed. The Korean stock exchange, after an initial dip, saw a remarkable recovery, gaining almost 20% in the last 2 months. And it's not just Korea and India. There are indications that the UK might be the next to join the ranks of nations banning short selling. A UK Parliament member expressed concern about predatory short selling practices, emphasizing the need for a global re-examination of rules governing short selling. The member called for transparency mechanisms, daily reporting, enhanced investigative powers, and stricter penalties for market manipulation. The international nature of financial markets demands a coordinated global effort to address these issues. This coordinated effort is gaining momentum globally, with countries recognizing the systemic risks associated with short selling. While several nations are taking decisive action, it's noteworthy that the United States seems to be lagging behind. Kristen Shaughnessy highlighted the disparity, citing a case where Goldman Sachs manipulated 14 billion shares, but faced only a $3 million fine. In contrast, countries like South Korea, India, and the UK are taking more aggressive measures against market manipulators. Shaughnessy's tweet drew attention to Goldman Sachs' actions from October 2015 to April 2018, during which they mismarked around 60 million short sale orders, affecting over 14 billion shares. The lack of transparency in naming the targeted stocks adds to the concerns. This raises questions about the effectiveness of regulatory measures in the United States compared to other nations actively addressing market manipulation. Despite these challenges, there is a silver lining for those who have been advocating for more stringent measures against short selling.
Over the past 2 days, Nvidia has surged to new all-time highs, dealing a severe blow to short sellers. Breaking through the $500 resistance, Nvidia soared above $540 per share.
This upward movement translates to substantial losses for short sellers, potentially in the tens of billions of dollars. But why does Nvidia hitting new all-time highs spell trouble for short sellers? To understand this, let's revisit a list from 2023 detailing the stocks where short sellers incurred the most significant losses. Tesla topped the list, with short sellers losing $0.2 billion. Coming in second was Nvidia. So, as Nvidia continues its upward trajectory, short sellers are facing daily losses amounting to billions of dollars. The recent 10% surge in Nvidia over the last 2 days has only intensified the losses for short sellers. These financial institutions have been borrowing extensively from the federal bailout program to cover their losses. As revealed by MC Biggums on Twitter, these banks are now borrowing a staggering $10 billion per week from the Bank Term Funding Program. The total cash drawn from this program increased from $113 billion at the end of November to $141 billion at the start of January, indicating a substantial cash flow to support these banks. However, this borrowing spree is not without consequences. The Kobisi letter highlighted that unrealized losses now constitute 33% of all bank equity capital in the United States. Banks are grappling with nearly $700 billion in unrealized losses, stemming from both loans and equities. Even institutions like B. Riley, which reported record revenues, found themselves in the red due to unrealized losses on equity positions. To put this into perspective, the Kobisi letter compared the current scenario to the worst point in 28, stating that unrealized losses accounted for only 5% of equity capital back then. The rapid rise in unrealized losses since the 2008 crisis indicates an alarming trend that demands attention. In conclusion, the global crackdown on short selling is reshaping financial landscapes, with countries actively implementing measures to protect their markets from manipulation. While challenges persist, such as the regulatory disparities between countries, the recent surge in Nvidia, and the escalating losses for short sellers may signal a turning tide. As the world collectively addresses the issues associated with short selling, the financial markets are witnessing a paradigm shift towards greater transparency and accountability. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.